I think Clover Health is going to be fine. Currently going for 79 cents right now, 391 million market cap. They are down about 7% in the past year. They are still currently selling under their SPAC IPO price. Once considered a meme stock, they actually focus on preventive care and providing healthcare for America's seniors. They offer Medicare Advantage plans, and using data and technology from Clover Assistant, they empower physicians to make the best health recommendations. Lately, there's been some news about the company needing to raise extra capital. We'll take a deep dive into the financials and see how they're really doing. So coming in from the latest Q4 2023 earnings, we're going to go over to Andrew Toy. Pretty much Andrew Toy talks about how the company's strong performance in 2023, despite some of the challenges they've had in the Medicare Advantage ecosystem, there's a lot of improvement happening with Clover Health. And some of those improvements are going to be in financial metrics, notably a decrease in the insurance MCR medical cost ratio. Also, the company does aim for profitable adjusted EBITDA in 2024, while also continuing to invest in their core technology asset, which is the Clover Assistant. And so pretty much he summarizes the momentum they're having in R&D, strong Clover home care coverage, and they keep emphasizing how they are going to achieve profitability by the end of 2024 without the need of additional capital. Now here's some of the quarterly data. The last column here on M is going to be the data that was just presented in the earnings transcript. We'll go ahead and compare some of the data in the previous year. Some of the things: earnings per share, total revenue, cash flow per share, cash flow from operations, and their operating expenses. We'll see the improvements that have been made year over year. So take a look at total revenue. It's actually been declining year over year for the past year. And the main reason for that is they're out of the ACO REACH. They were expanding too fast, so they had too many expenses and they wanted to cut it down. So they're slowing down their growth. They want to improve their other metrics first and become cash flow positive before they initiate their growth phase. So take a look at earnings per share. Pretty much for the past year, there's been improvements in earnings per share, negative 15 cents compared to negative 18 in December of 2022. That is a 16% increase year over year. Not a huge increase compared to the previous June and September quarters, but still better than last year. And as you can see, there is a trend. So if we go from December 2 years ago, there is a trend towards positive earnings, and hopefully they can hit it this year. We'll just have to wait and see. There's also been huge improvements in their cash flow. This isn't really talked about much, but if you dig deep into the numbers, they have been achieving positive cash flows in a couple quarters already. So take a look at cash flow from operations right here. Latest quarter had a 54% increase. So they posted negative 95 versus negative 209. That is a huge jump up in improvement in their cash flow from operations. So in the May quarter of 2023 and June 2023, they hit positive cash flow. Those were the biggest improvements in cash flow compared to 2022. More than 200% improvement on both those quarters. So that is a huge sign. I don't know why it's not talked about more. Now, one of the major improvements that they are experiencing and they talk a lot about is the improvement in their operating expenses. So if we take a look at the most recently posted operating expenses, they posted 558. They were spending about $1 billion in operating expenses. Now they're down to about half, 500 million. That is a 45% increase year over year. And if you take a look at the past year of 2023, they've been improving it every quarter steadily. This is a good sign. So when we take a look at total revenue and we compare it to operating expenses, they get the revenue from its Medicare Advantage plans, and until the exit from the ACO REACH program, the company's revenue streams are significantly influenced by premium earned from Medicare Advantage enrollees and payments from CMS. 2 years ago, the company reported a significant amount of revenue from its operations, so they do have the capacity to generate income from its core business. However, when they decided to exit the ACO REACH program, it started impacting their revenue streams. And this sort of highlights the need for strategic adjustments to maintain their growth revenue. But on the other side of it, when you take a look at their operating expenses has also improved. So they slowed down their revenue growth, but they improved their operating expenses. So we want to watch the relationship between total revenue and operating expenses because it is critical for Clover Health's path to profitability. In the end, we should all sort of monitor how they manage their operating expenses in relation to their revenue growth. So the need to raise additional liquidity is pretty much the main question we're all asking here. With their successful execution of their strategic initiatives and improvements in financial performance, as we could see in the past year, they had major improvements in their operating expenses. Could pretty much reduce their dependence on external financing over time. So in summary, while Clover Health does face a lot of challenges right now, their strategic focus on technology, market expansion, and their operational efficiencies outlines a path forward. Let me know what you guys think. I think they're doing the right thing with slowing down the revenue, improving their operating expenses so they could be sustainable without the need of external financing. I hope you guys like this video. Let me know what you guys think.